This is a sample of a personal planning and forecasting tool. If you're retiring or just retired, some things you have to consider in that is included in this list from tax optimization, health, living and lifestyle, estate planning, lifestyle and contingency funds, and all the tools that you may want to use in building a good financial plan. These are the assumptions we used in calculating this financial plan from all the assets, the liabilities, and the current net worth, also the inflation and growth in different condo as well as the house goes, et cetera, et cetera, et cetera. This is our master book workbook, which is integrated. It shows all your assets, your liabilities. It gives you a net worth statement. Also shows you where your cash is going to be injected in as far as the cash flow goes, the income. Shows all your expenses from home to living to vacations. There is some discretionary amounts, which is vacations and eating out. Is one other one. Then you've got the miscellaneous payments, and that's like in this situation, payments for additional cars, and or if you looked at a condo sale, you've got minus 175, and the payments as far as that goes to 206, and that's reflective of the sale of a condo that I just put in there. End result is you'll be able to adapt this to what your needs are and change accordingly. As you can see, all the expenses or cash flow that we're sending money out is all broken down, like I mentioned, from home, vacations, et cetera, et cetera. These can be adjusted as you see fit. It's got the inflation rate of 3% included in this. As I mentioned, you can probably change that, or if you like, change it to a different percentage, or go in specific different line items and change accordingly. End result is in this situation, the cash flow is outflow is shown on the bottom here. The following is just some backup that we have on each of the expense items. We've checked the internet on different situations and just give you a feel what is being spent for different occasions, such as if you're renting versus a condo versus a different size of house, to you're owning a car and what's the cost associated with that, from a electric to an SUV, the changes in that respect, your home's health costs. Go further down, each of these are identified. Monthly grocery costs is an interesting one. I've also included a cost comparison, home versus fast food versus restaurant, and it's quite a significant difference. I mean, you're paying $18 to $28 for a chicken meal. You can make that same meal about for $5 at home. Other things, alcohol consumption. Some people drink, some people don't, but maybe you want to include that. Clothing and footwear, and other expenses. Following is shows where the cash inflow comes from. Some of the areas are not taxable and some are taxable. I identified the ones which are taxable and not taxable in respect to that. And what I've done is this has to match up to your expense column so that the cash inflow matches the cash outflow. And most of the time I've using the RRSP withdrawal to balance that out. Some cases I took some marginal amounts of TFSA out as well. The following is a breakdown of the taxation on different amounts of income. As shown, we've got a $60,000 and $85,000 amounts, and one is 11%, the other one's 16. I use 17%. This is a breakout of the net worth based on the different factors that we used, including the return on 1% on the house, as far as the annual return on investments 5%, and an inflation rate of 3%. The bottom line is 1.737, and the factor right now, the cumulative factor is 2.09. That means you divide by 2.09 to calculate today's dollars, and that would still equate to about $900,000 in today's dollars, which is quite significant. Now I'm just going to do some changes here. Let's first of all, let's change the house instead of 1%. Let's move it to 2%. Just do a bit of a simulation here. So I move that to 2%. Now we're up to 2275. Let's try the inflation rate, moving up to 4%, a little bit higher. We're down to 1982, but our investments dropping down to 4%. That's on that one, and 4% on the TFSA. That's down to 1732. Again, you can simulate a number of these to what your needs are and just give you a sense of security on that basis. These are some of the major benefits of doing a 25-year plan.